I want to run a quick experiment with you. Imagine I walk up to you on the street and offer you a coin flip. Heads, you win $100. Tails, you lose $100. Perfectly fair, right? 50/50ths. Expected value, 0. Would you take that bet? Most people say no. And that's fascinating. Because mathematically, you should be indifferent. The odds are identical. The amounts are identical. But something in your gut says, no. The loss is not worth the risk. Now here's where it gets interesting. Researchers asked this question thousands of times, across dozens of countries, different ages, different income levels. And they found that for most people to willingly take that coin flip, the potential gain needs to be around $200. You need to be offered double the upside just to offset the emotional weight of a potential $100 loss. That's not irrational behavior. That's loss aversion. And it is quietly destroying more wealth than almost any other force in finance. Here's the thing that changed how I think about all of this. Loss aversion isn't a flaw. It was a survival feature. Go back 50,000 years. You're a hunter-gatherer. You find a bush full of berries. A stranger offers you a trade, gamble your berries for a chance at twice as many. What's the smart play? You don't gamble. Because if you lose those berries, you might not eat tonight. The downside, starvation, is catastrophic and irreversible. The upside, more berries, is nice, but you'll survive without them. Asymmetric stakes. Rational caution. Fast forward to today. You're watching your investment portfolio drop 8% in a day. That same ancient brain fires the exact same signal: danger. Protect. Get out. The problem is, a market dip is not starvation. It's not irreversible. It's not catastrophic. But your nervous system doesn't know the difference. Daniel Kahneman and Amos Tversky documented this in the 1970s and won a Nobel Prize for it. They called it prospect theory, the idea that people evaluate outcomes relative to a reference point, and that losses feel roughly twice as painful as equivalent gains feel pleasurable. Twice. That number changed how I saw every financial decision I'd ever made. Let me tell you about the worst trade I ever made. Not the one that lost the most money. The one that cost me the most opportunity. A few years ago I bought shares in a company I genuinely believed in. The stock dropped about 22% over the next 3 months. Now, nothing had changed about the company. The fundamentals were the same. My original thesis was intact. But every morning I'd open my portfolio app and feel this low-grade dread. This background noise of, "You made a mistake. You're losing. This is bad." So what did I do? I sold. Not because the investment was bad. Because I couldn't tolerate the feeling of being down. The stock recovered fully within 6 months and went on to gain another 40%. I didn't lose money on that trade. I broke even. But I lost the return, because loss aversion made the temporary pain of being down feel more real than the rational case for holding. And this is the pattern I see everywhere once you know what to look for. People hold losing stocks for years, refusing to sell, because selling makes the loss real. Same bias, opposite behavior. People take profits too early on winners, because they're terrified the gain will disappear. Same bias, different direction. Loss aversion doesn't push you in one direction. It distorts your relationship with outcomes in both directions. Once I understood this bias, I started seeing it everywhere. Not just in investing. Number 1, the disposition effect. This is what researchers call the tendency to sell winners too early and hold losers too long. Studies show that individual investors are 50% more likely to sell a stock that's up than one that's down, even when the down stock has better future prospects. Think about that. We systematically exit our best positions and cling to our worst ones. Because gains feel fragile and losses feel temporary. I did this repeatedly before I understood what was happening. I'd sell something up 15% feeling smart and relieved, and hold something down 30% feeling like it just needs time. Number 2, real estate anchoring. This one hits close to home for a lot of people. Someone buys a house for $400,000. The market shifts. The house is now worth $340,000. Rationally, the house is worth $340,000. That's what someone will pay for it. But the owner can't sell for $340,000. It feels like losing $60,000. So they wait. Sometimes years. Paying mortgage, maintenance, opportunity cost, all to avoid crystallizing a loss that has already happened. The loss is real whether you sell or not. But loss aversion makes the act of selling feel like the moment of loss. Number 3, career and salary decisions. I didn't expect this one when I first read the research. Studies show that people are significantly less likely to leave a job when they've recently received a bonus, even if a better opportunity exists. The bonus becomes a reference point. Leaving means giving it up. That feels like a loss. Even if the new job pays more on net. Loss aversion isn't just a trading problem. It shapes every financial decision that involves a reference point. Which is basically all of them. There's a study I keep coming back to. Researchers at Stanford put participants in an fMRI machine and had them make financial decisions. When people faced potential losses, the brain region that activated was the insula, the same area that processes physical pain and disgust. Not the rational prefrontal cortex. The pain center. Your brain doesn't distinguish between losing $100 and touching something that disgusts you. Both register as threat. Avoid. Escape. This is why telling yourself to just be rational doesn't work. You're not fighting a bad habit. You're fighting a pain response. Another study, this one by Terence O'Dean at UC Berkeley, tracked 10,000 individual brokerage accounts over 7 years. He found that the stocks people sold outperformed the stocks they held by an average of 3.4% over the following year. People were systematically selling their best assets and keeping their worst ones. Loss aversion in action. At scale. Costing real money. Every year. So here's what I've changed. Practically. Not theoretically. First, I reframe losses in time, not dollars. When a position is down, I no longer ask, how much have I lost? I ask, has anything changed about why I bought this? If the answer is no, the loss is just noise. I'm not down money. I'm in the middle of a process. This sounds simple. It took me 2 years to actually internalize it. Second, I write down my exit criteria before I buy. Not a price target. A thesis. I will sell this position if X changes, or if Y happens. That way, when I'm sitting with a 20% loss and my insula is firing, I have a document written by the calm version of me that says, this situation doesn't meet your exit criteria. Hold. Takes the emotion out of the moment because the decision was already made. Third, I stopped checking my portfolio daily. This was hard. But research shows that the more frequently you check, the more likely you are to see a loss on any given day, and the more loss aversion you experience. Quarterly reviews. That's it now. Out of sight is genuinely out of mind for System 1. Fourth, I started thinking in percentages, not dollars. A $500 drop in a $50,000 portfolio is 1%. But if you're staring at $500 in red, it feels enormous. I changed my portfolio display to show percentages only. The number just hits differently. Less visceral. More useful. Here's what I want you to take away from this. Loss aversion is not weakness. It's not a character flaw. It kept your ancestors alive for 200,000 years. But the market doesn't care about your nervous system. And if you don't understand this bias, the market will collect it from you. Slowly. Quietly. Over decades. The investors I've studied who consistently outperform? They're not smarter. They're not luckier. They've just found ways to create distance between their pain response and their decision-making. That's the whole game. If this video made you think differently about a decision you've made, or one you're about to make, drop it in the comments. I genuinely read every one. And if you haven't seen the first video in this series, Why Your Brain is Wired to Lose Money, it's linked below. Watch that one next. I'll see you there.